Hey accountants, Mrs. Lamphere here. Wanting to go over Section 2 of Unit 7 with you, just to kind of summarize information for you and help explain a few things. So this is again looking at Section 2 of Unit 7 called Accounting for Sales and Cash Receipts. Objectives for this section: we want to be able to explain the difference between a service and merchandising business, analyze transactions relating to the sale of merchandise, explain the difference between a retailer and a wholesaler, record a variety of sales and cash receipt transactions, which we have a few examples that will help us clarify that, and then define accounting terms introduced in this chapter. So when we're accounting for merchandising businesses, if you didn't know, a merchandising business is one that buys goods and sells them at a profit. So this could mean they're either a retailer who sells their goods to the end consumer. So many of your stores are retail stores that you, the consumer, go and buy things from. Or a merchandising business could be a wholesaler. So goods could be bought in bulk from the manufacturer and then resold in smaller quantities to retailers. So not directly with the end consumer. Or a merchandising business could be both. So for example, I'm sure you've all probably heard of or been to a Costco or a Sam's Club, where they kind of act as both a retailer and a wholesaler, because they are able to sell to retail stores as well as the end consumer if they're wishing to buy in bulk. So that is what a merchandising business is, and this is just a brief overview of the operating cycle of a merchandising business. As you can see, first they do is they purchase goods for resale. They sell those goods to consumers, could be for cash or on accounts, collect cash from accounts, and then that cash that they earn enables them to buy more goods. Pretty basic information, and you guys probably already were like, oh, well, duh, that's how it operates. So no big surprise there. So then accounts that are used by a merchandising business. What we're going to look at first is merchandising inventory account. So the inventory account of a business is represented, it's an asset account. So their inventory is items that they own, getting ready to sell, but at that point they still own them, so it's an asset account. So this is what a merchandise inventory account is going to look like. As you can see, we debit as the increase side, and we decrease on the credit side with the merchandise inventory because it is an asset account. So that should trigger those memories for you back in Accounting 1, that since it's an asset, it increases on the debit side, decreases on the credit side, and has a normal balance on the debit side. So we're also going to work with some sales accounts, which you should remember is a revenue account. And as a revenue account, we decrease on the debit side and increase on the credit side, as well as our normal balance is recorded on the credit side. So that should be a bit of a review for you, hopefully. Hopefully you guys remember that from Accounting 1. Now we're going to analyze some transactions. These are going to be a little different than what we've worked with in Accounting 1, but you'll see some similarities as well. So when a sale is made on account or is recorded as a charge sale or a credit sale, you guys should remember that refers to the sale being made on account by an account holding customer. So this account is also known as a charge account. And when a purchase is being made with our business on account, then that would be recorded in our accounts receivable. But if we're our business making a purchase on another store's account, that's going to be recorded as accounts payable. Should be triggering some reminder receptors in your brains right now. Store credit card sales. There are several different types of credit cards you guys are probably aware of or maybe even familiar with. So you could get either a credit card issued by the store. I know like Target and Sears are well known for their credit cards. So that would be buying on account. If you use that credit card, you have an account with them and you're going to make those payments later. There are also some non-bank credit cards. credit cards out there. This would be like your American Express or Discover cards. They're issued by corporations and not necessarily the bank. Items related to sales on account. A charge sales that involves the sales invoice and sales tax. And then credit terms on sales accounts state the time allowed for the payment. So all of these items are types of sale transactions, and your credit terms just kind of defines the plans for payment on these transactions. And you're going to see this symbol throughout this chapter, and we're going to go into it a little more here in a little bit. But so you'll see N over 30, and what this means is N stands for net payment, and 30 stands for 30 days. So what this symbol means is that the net payment for this customer is due in 30 days. So we're going to get to another example of that here in a little bit and explain it a little further. So something we're introducing that's going to be new to you guys in this section is an accounts receivable subsidiary ledger. A lot of businesses that have few customers might have individual accounts receivable for each customer, and that's what we dealt with in Accounting 1. We always had like accounts receivable Dave or accounts receivable Sherry, and we kept track of their accounts by person, and that's how they were recorded in our general ledgers. So now, when working with larger businesses, they may keep track of all of that in a separate ledger. So that's what we're going to look at right now. So this is subsidiary ledger is just another book, another ledger that contains the detailed information as a controlling account in a general ledger. So all that means is that we're going to have a separate book that we track all of our separate accounts receivable in, and then in our general ledger we'll just have kind of the controlling account is what it's called. So the accounts receivable controlling account is what we'll see in our general ledger. That's kind of the representative, or just kind of the balance of all of our accounts receivable. And then the accounts receivable subsidiary ledger will have all the individual accounts listed on it. So let's check out this quick video here from your text that kind of explains the accounts receivable subsidiary ledger. Okay, so all they're saying is basically now we're going to have accounts receivable as a controlling account and accounts receivable subsidiary ledger. So again, like our controlling account's kind of the umbrella, the overall balance of all of these accounts put together. So we're going to track all these individually in this second ledger, and then just show the balance in our main general ledger. So I hope that makes sense so far. If you have questions about that, make sure you come to our next Class Connect session and we can clear those up for you. Okay, I wanted to keep that up here. So when we're recording, let's get this back up and look at page 11. So here's an example of recording a sale on account. So we are used to, when we saw a sale, we were used to just recording it as sales revenue and maybe accounts receivable or cash if they were paying with cash. So now that we have this subsidiary account in the mix, plus sales tax is now in the mix, we're going to be working with several different accounts just on one sales transaction. So, for example, on January 5th, Olympic Sportswear sold merchandise on account to Kelvin Sports for $400 plus $24 in sales tax. Okay, so now first we want to identify all the accounts that are going to be involved in this transaction. We have our accounts receivable controlling account. Okay, that's like our umbrella accounts receivable. Then we have our accounts receivable Kelvin Sports, which is going to go in our subsidiary ledger. Then we also have our sales account and then a sales tax payable account. Okay, so we're working with 4 different accounts in this one transaction. So now we need to classify what type of accounts each of these are. So our accounts receivable, controlling and subsidiary, they're both considered asset accounts. Okay, that should be familiar to you. We worked with accounts receivable before, and they're always considered asset accounts. Sales, we'll be working with our sales account, which you should remember is a revenue account. And then we have sales tax payable, which just by seeing this tax payable word or words, that should tell you that this is a liability account. So those are the different types of accounts we're working with. So now let's talk about the effects that each account will have. So our accounts receivable, controlling and subsidiary are both going to increase by $424. And then sales will increase by $400 and sales tax will increase by $24. Does that make sense? I hope. Just because looking back up here at our transaction, they bought $400 worth of merchandise, plus they have to pay their sales tax, so that will affect their total of accounts receivable. So then we want to split that up, though. We want only $400 of that's going to go towards the store, and then the $24 will go towards sales tax that the store has to pay later on at the end of the year. So then we look at our debit and credit rules. This is going to increase our asset accounts because they're paying on account, so they're increasing their overall balance for what they'll owe. So that's going to be recorded as a debit. So both of those account receivable accounts will be debited. And then when we look at the credit rule, we're going to be increasing our revenue account because we made a sale, so that will be credited. And as well as our tax payable, which is a liability account, will also be increasing, so it's going to be credited as well. So here's what it's going to look like set up in T accounts. We have our accounts receivable increasing by $424, and also our accounts receivable subsidiary. So these are both being debited for the same amount. This again, oops, didn't mean to do that. So this again is our main, like I said, the kind of umbrella account that just shows our balance, and then this one will deal with Kelvin Sports' individual account on the subsidiary ledger. So both of those are increasing by $424. Then we have our sales account increasing by $400 as a credit, and then sales tax payable. Again, up here we just said that it should be a credit, so this table has it listed incorrectly. It should be increasing as a credit for $24 like it's listed up here. And so then it shows how those transactions are then recorded into the general journal. So as you can see, our accounts receivable debited for $424, sales and sales tax payable both credited for their amounts. And what they don't show you is that, so our subsidiary ledger is recorded in a separate, in its own separate ledger. So that's where we specified Kelvin Sports, which it looks like it did here, but normally that would only be recorded in the subsidiary ledger. So that is an example of how these transactions are identified and recorded. And we're running out of time for this first video, so I will continue with this section in the next one.